My name is Andrew Dixon. I'm the founder of the Crowdfund Media Group, and we are the publishers of Crowdfund Insider. We cover all things online capital formation as well as fintech. And today we're going to have a discussion about the crowdfunding industry in the US as well as Europe and the UK, about the performance during 2024 and some expectations for 2025. And once again, we have a group of panelists that are experts in the industry that will share their wisdom and knowledge and their expectations for the future. And I'm going to ask each of them to do a quick intro so you know who they are. And I'm going to start with Emily from Republic here. Emily, thank you for coming today. Would you please share a little bit about yourself with the group?
Absolutely. Thanks, Andrew. And hi, everybody. Great to be here. I'm Emily Pollack. I'm the managing director of Republic's U.S. retail division. Been with Republic for about 3 years. And for those unfamiliar, Republic is a private investment platform. We operate a Web3 advisory arm, an institutional arm that has a digital hedge fund. And then we also have our global marketplace, which is comprised of our US Republic.com and Republic Europe. But excited to share our insights on crowdfunding and capital raising that we've seen in 2024 and kind of what we see coming up in 2025.
Awesome. Stormer, welcome once again.
Thank you. Great to be here and nice to see everyone joining as well. My name is Stormer Santana. I'm the director of sales at the Dalmore Group. We're a registered broker-dealer, tech-enabled broker-dealer, coming up on 21 years of history operating as a BD. We're heavily focused in online fundraising, focusing on Reg CF, Reg A+, and Reg G offerings, and really looking forward to diving into the thematics of 2024 and what the outlook looks like for next year.
Thank you, Stormer. And of course, we have Sherwood Neiss, otherwise known as Woody, a true OG in the industry. Woody, tell us about yourself.
Well, how far back do you want me to go? No, just kidding. It's great to be here. Thanks, Andrew, everyone. Great to be here with you. Woody Neiss, principal at Crowdfund Capital Advisors. We cover the industry from a research and analytic perspective through our sister organization, C-Clear, which collects data on all the companies that are raising money online. We produce a 150-page annual report that lets it's a deep dive in the industry. We've got a venture fund that has taken the data and looks for opportunities in the space. And we've got a secondary trading compliance product that helps these companies that have a market for secondary trading list on alternative trading systems, and we help with the compliance of that. So sort of touching a bunch of different things.
Awesome. And I'd like to mention that Woody is a true OG. There's been a lot of people that have been involved with the industry that have claimed to be, there at the beginning, but he really was. He is one of the effectively the authors of the text that went into the Jobs Act that legalized securities crowdfunding. So we're really happy to have him here. So to kick things off, the Jobs Act was signed into law in 2012. It took several years for the Securities and Exchange Commission to finalize the rules. It was in 2016 when Reg CF, regulation crowdfunding, was actually activated, where people could actually utilize the exemption. So now we don't quite have 10 years of information, but we have a good number of years. And of course, Woody has tracked it all. So to kick things off, I think it's good if I shift the microphone over to Woody. He's brought some data points with us. While I have them, I haven't looked at them yet. So I'm going to ask Woody to walk us through the data that he has for 2024. And then I'm going to invite our other panelists to kind of share their insight and what they saw on their platforms during the past 12 months. So Woody, take it over. It's all yours.
Okay, let's just jump right into the next slide and go into some of these data points. So as Andrew said, it started in 2016. 2021 really was a peak for the industry. There was $500 million plus in commitments, over $500,000, over 500,000 checks that were written. But then we saw this pullback that happened in 2022 and the stabilization that really, I think, occurred in 2024. And I'm going to sort of dig into the nuances of 2024 so you could see what I'm talking about. So let's just jump to the next slide. This next slide shows you capital commitments over time. If you look at that stacked column that's in 2024, the green area is our estimate for what's going to happen, come in for capital commitments for December. We've got the blue line, which is really the Reg CF side of commitments that have taken place over time. You can see that what I was talking about earlier, where it peaked in 2021 and it's trailed off, even so in 2024 to a lowest level that we haven't seen since 2020. But what's happening here is we've got these parallel offerings that are coming more and more into play. So in 2021, the SEC increased the cap that issuers can raise from 1 million to 5 million. And we saw a huge uptick in the number of issuers coming online. But because of the supply chain issues, because of inflation, because of the collapse of Silicon Valley Bank, there was this dwindling down that we've just seen. And I believe this is now the stabilization sort of took place in 2024, where we sort of bottom out where the retail investors are. And I'm going to talk a little bit about that in a second too. But we've seen this growth in that sort of yellow area and the parallel side of offerings. And I think that's just going to continue to grow, because what I'm seeing in the data set itself, when I look at it, is we're seeing a lot of angels and VCs that are participating in these deals more and more so than they've done in the past. They come with bigger checks, they come with bigger networks, and I think that's adding to these offerings. So while there's been a drop off in the Reg CF amounts, we've made up for it in these parallel amounts. I think we'll make up for it in December. And so what we're going to see in 2024 when we end the year is we're going to just eke out 2021 in terms of the total commitment for the industry. Now, I want to put the caveat in there. When we integrated our data with Bloomberg, one of the things that they said to us is we're looking for the total amount that's raised in a round. We don't care if it's a Reg CF, if it's a parallel, we want to see the total amount. So when we present our data, and not everyone presents it this way, we present it as the total amount that's raised in a round from a company that's raising money primarily through Reg CF, but might have one of these parallel offerings going on. So that's why we're showing this uptick. But I think it creates more of a better understanding of what's happening in the industry for people that are actually watching what's happening. So if we go on to the next slide, I talk about this stabilization because I feel like we've sort of worked through the issues with the collapse of Silicon Valley Bank. We've had inflation come down. Investors have seen the stock market go to historic highs this past year. And I think that sort of trickle down effect is stabilizing the marketplace, which means that more investors are going to come in. So like I said, we're going to end up with $565.7 million, I think, in commitments for the total year. We're going to be flat in terms of the number of offerings. Last year, it was 1466. I believe it's actually going to be right on target with that for this year as well. We do have the most activity in Q3 and Q4 each year. And so, I'm interested to see how December plays out. We've had $194,000, keep on saying dollars, 194,000 checks that were written, far off from that high of 500,000 in 2021. But we've seen the average check size increase, because if you divide this increasing amount of investment by a fewer number of investors in the space, that just means by default, investors are writing bigger checks. So to me, that means that investor sentiment is increasing, where investors are confident in what they're seeing in the marketplace. And I think this is driven by, and I'm not going to show you a slide of this, I'll just tell you that the type of companies that are coming into the marketplace are vastly different from what happened when the industry launched in 2016. Back then, the 65% of the data set was, pre-revenue startups, so less than 3 years old. Now, over 65% of the companies coming into the marketplace are post-revenue, established, over 3 years old businesses. So it's a very different dynamic. These are more established, less risky type of businesses. The challenge, I think, is really in the valuations, which is a whole nother conversation that we can go into. But I think we've created this opportunity for 2025, which we'll talk about in a bit, to be a great year. If we go on to the next slide, I want to talk about the nuance also in terms of the number of offerings. I think there's a lot of time spent on, equity crowdfunding. Okay, but nobody's really talking about, what's happening in the debt side. And I think this slide sort of lends color to what's happening in that space. You can see that 2024 is really on par with 2023 in terms of the amount of debt offerings. So debt offerings are increasing over time. We saw the drop off in the equity offerings. I think we're going to make that up, over this year and next year. But I think there's a story to be said in these debt offerings because, we were talking about this on a call earlier today. If you're a restaurant and you want to do one of these debt offerings, you're going to pay 30% interest to a bank or something. But the average interest on these debt offerings is 12.2% right now. So there's good returns for people in that space. But, of course, the opportunities with a lot of these new AI issuers that are coming into the space and the software technology, I think is in the equity side. It all really depends on, who's got the right valuations in there. We can jump to the next slide. And this shows you how we've had this increase in retail participation in 2021. This breaks down the number of checks by industry. So you can sort of see which industries are the hottest. It tends to be technology and software, telecommunications and media, financial services tends to be very high. But what I love about this chart is just shows you the broad application of both this across the entire industry from both an issuer perspective as well as an investor perspective. Investors aren't just interested in software and technology. They're deploying capital all across the industry. So we saw a contraction in the number of checks written to being 2024 being the smallest amount since 2018. But you can see there's still a broad distribution of checks among all of these offerings in these industries. We can go on to the next slide. Oh wait, no, I'm going to stop right there because we're going to talk about projections. Yeah.
All right. Yeah, we'll get back to that. We'll get back to the future in a minute. But thank you, Woody. That's always awesome information. I'd like to. I'm glad to see that you're incorporating Reg D in there because it does provide actual insight into the industry. I think for investors, they really don't care which exemption it is. They're just looking at the business and can I invest? And I think that the industry people, the inside people, we sometimes tend to focus on acronyms and things that most people aren't really concerned about. I'd also like to mention Reg A because I don't believe you have data on Reg A, but that's a different exemption and that's harder to track. There's some information out there, but I think that the Reg CF information is just cleaner information in general. I also wanted to ask you, Woody, because safes tend to be a popular a vehicle to use for Reg CF. Are you putting those in debt or equity? Where does that show up?
I mean, I put it in equity. I'm one of these people where I like debt in my brain, straight debt. So straight debt to me, even though convertible debt is debt, I look at debt and revenue share because I just like to bucket it like that. Because I think I look at it from the point of view of the people that are using the capital. Okay, so a convertible note is really meant for a startup. A debt or revenue share, I'm looking at the type of issuers that are using those, and it's Main Street type of businesses, or someone's got a movie and doing a revenue share on that. So that's how I sort of break it up. But safes, I'm putting in the equity side.
Okay. Thank you for that clarification. You mentioned valuations, and I think you do track valuations. Have you seen them go up, down, hover? How's that going?
It's a nuanced thing because valuations have increased over time, but that's only because the type of issuers that have come into the marketplace have become ones with more revenue and more established. So by default, they have higher valuations. But what we do is we sort of break it down into your pre-revenue startups versus your post-revenue established. We look at pre-revenue and post-revenue established as well. And in those four different categories, we're seeing valuations increase for your post-revenue established. We're seeing it also increase for your post-revenue startups. We're seeing it drop in your pre-revenue startups, where you would hope it would fall back to like that $5 million figure, but it's still inflated at around 9 million. I don't think, where you've got these ideas, you can really justify, this is my own personal bias, by the way, that you should be able to justify a valuation higher than 5 million, because I think 5 million is also generous for an idea, where you have not done nothing. But it all depends on how you're looking at it. In general, we're seeing valuations increase, and we've seen some corrections in the lower areas.
Another sector that I believe you track is underserved communities. And I was watching a hearing in the House of Representatives today, and there was a discussion about how venture capital does not exactly serve, women and minorities. And correct me if I'm wrong, Woody, but hasn't online capital formation been more effective in providing access to capital to these underserved groups?
Yeah, so we track the minority status of the founders. So if there's women or minority founders, we tag that in our data set. And when you look at what's happened over the past 12 months, about 40% of the offerings had at least one woman or minority founder as part of the founding team. That just doesn't exist within the venture capital space. I think they claim to try to fund 2% of women and minority founders, but the reason why that number is so high, and it just goes down to the way this industry is structured, is people are raising money from their customers, their family, people that are close to them, and many of those customers look like them. And so you're getting people that are minorities that are investing in minorities. You've got women entrepreneurs that are raising money from women investors, and it just sort of makes sense. But I think that number and that percentage is something that we really should be talking about, because it just doesn't exist anywhere else. And if people really understood the impact that this is having for that underserved part of the private capital markets, we'd probably get more attention. We'd probably get more government focused on it. We'd probably get more capital in the space for people that really care about it. And I think that's where a lot of our attention is these days.
Awesome. That's really helpful. One more question before I go out to our other panelists here. Are you tracking exits?
It's a tough one, but we do try every year when we write the annual report, we try to write about the exits in the space. And one of the ways in which we do that research is we look at filings with the SEC in terms of like S1s or any follow-on round. And I think we've tracked about 78 exits that have taken place in the terms of either an IPO or a filing for an IPO. I think there's been more of those that have done like a Reg A offering, which is a quasi-public offering. But we're trying to track that in the data set itself too. We track valuation growth over time between offerings. And so within that itself, we can see that there's about $18 billion of value that's been created between companies that have done one round online and their most recent offering online. So there's money to be made in there, and we're trying to capture all that, but it's not the easiest thing to get.
It's not the easiest thing, and I think it's in my opinion, and you guys can disagree with me, I think it's a weak point for the industry, because I think there should be better transparency on exits and for acquisitions, because typically an investor is going to get their gain when that happens, or the emerging side of secondaries, which we're going to talk a little bit more about if we have more time. So this is all great data, Woody. Thank you for sharing this. I want to jump over to Stormer, and I want to hear about what you guys saw specifically at Dalmore Group this past year, this past 12 months. I know you guys do the full stack of exemptions, but you've been really big in Reg A. Reg A Plus is a securities exemption that allows an issuer to raise up to $75 million, but you have to provide offering documents to the SEC, which must be qualified first, which is a bit of a speed bump for companies that need money today, or they don't have a lot of patience in pursuing securities crowdfunding and offering. So Stormer, what have you guys seen? CF, A plus, D, whatever. What's going on at Dalmore right now?
Sure. Well, I think, a lot of the data points that Woody touched on, we can definitely echo, specifically around the idea of looking at these exemptions as tools, not necessarily the go-to guaranteed solution for raising capital. And so when we look at like platforms, right, they are often forced into doing a CF or doing an A or not doing a D. And we look at these as kind of like a toolbox that our issuers can leverage. And so we see a lot of our issuers bolting on crowdfunding solutions to their existing fundraising tactics via potentially Regulation D, 506C, or B. So I would say we're uniquely positioned from that standpoint. We're a broker dealer, we're tech enabled, we've supported 1,000 companies, and a lot of those issuers are tending to be on the more mature side of issuers that are leveraging these exemptions. Potential funds, bond managers, startups looking to raise capital through early crowdfunding, but then scaling with Regulation D as well. So, I pulled a few of our stats as well. We're heavily focused in Reg D and Reg A. That's kind of our sweet spot because the issuer tends to be a little bit more mature, more established, has the infrastructure behind them to leverage these exemptions and scale. And really that's what our issuers are looking to do, is they're looking to expand their suite of fundraising to a wider audience that has traditionally not had access to their fund products and whatnot. And so, to date, looking at like Q3 for up to Q3, we've raised just over 500 million in capital across our issuers, and I would say close to 650 as we close out the year. So really, really strong performance coming from our issuers. A lot of those issuers being historical Reg D and looking at Regulation A as a way to bolt on and expand their audience to the more retail channel. So that's been a huge theme for us. And I think, you mentioned, investment amount that's been raised, or excuse me, average investment going up 15%. I think that's a really, really strong number to look at and reference, because often these exemptions, they're spoken as easy access or early access to capital, $100 minimum investment. And the challenge that issuers often try to formulate is, how can I raise $5 million with $100 checks? And seeing that minimum investment start to increase over time, I think provides validity and maturity to the industry as an additional capital source for companies looking to scale. So, I think we're a very big proponent of advisement, providing strategy, and ultimately looking at these exemptions as tools so that they can leverage Regulation D, which might be a little bit more of a concrete way to raise your initial capital round, but also bolting on Regulation CF or A to complement and expand your community. I think at the end of the day, community is hyper focused and crucial to any online capital raise, because that's what you're looking to accomplish, is scale your audience and your network, which can fuel this offering and hopefully the offerings there on out. So I'll pause there. That's kind of my thematics of what I've seen over the last 12 months.
Okay, so is Reg A, is that your biggest market? So you anticipate up to 650 million for 2024. Is that mostly Reg A? And is that an increase over 2023? Granted, the last couple of years have been kind of choppy due to, things like, pandemics and, global strife. But
I would say that the majority of that capital is a combination of Regulation D and Regulation A. It's definitely an increase from last year, but I think it's a level of maturity of issuers that are coming to look for these solutions. And so a lot of our funnel starts with mature companies who have only leveraged Regulation D, and they look at Regulation A as that vehicle to expand their audience, create brand awareness, create community, and ultimately seed and fuel their fundraising efforts. So I continue to see more interest from the sophisticated managed capital that look at these exemptions as a way to expand their investor audience.
okay, so I know you guys do a lot of repeat issuers. Can you provide some insight into that? Because and also some types of issuers, like you're big on fractionalization, and you've enabled really different types of offerings, like racehorses. Can you share some insight as to what you're seeing in that segment of the market?
Absolutely. So I think when we look at the scope of issuers, there's perpetual issuers who would be a bond, a fund. They're constantly raising capital. There's the early stage startup or emerging companies that are looking for that first million, 5 million via Reg CF. And then there's the platforms, the fractional businesses who have their own community, own offerings, but need the resources and compliance support of a broker dealer in order to facilitate. And so that's exactly right. We power dozens of platforms in this space, whether it's collectibles, art, beverages, or horses. And a few of our issuers have done incredibly well with their asset class. And so that's a really unique model because that can leverage what's called Regulation A series structure, where you're launching one offering as the issuing entity, but have a series of LLCs or series of offerings within that. And in aggregate, you can raise 75 million across those different series offerings. Now, a lot of platforms come to us in their early inception and they're looking to scale and at least launch their first campaign. And a Regulation A offering can take quite a bit of time, very extensive, a lot of legal work to facilitate. But it can be powerful because you can scale and you can have multiple series underneath it. So it's a really great vehicle for issuers, platforms specifically, to go to market over a time period, right? Getting qualification, but then going to market with a handful of opportunities that their community can participate in.
Okay, thank you for that. It's very informational. I want to jump over to Emily now. You've been patiently sitting over there. I can just tell you're bursting with information. Republic is globally the largest securities crowdfunding platform in the world, due largely in part to your acquisition of Cedars, now Republic Europe. Can we start with the U.S. market and share what Republic is seeing domestically in the United States, Reg CF, Reg A+, Reg D, the kind of panoply of what Republic is doing in this country right now?
Absolutely, yeah. I'll start with the U.S. and then get into a little bit globally, since a lot of it is we kind of see ourselves as a global marketplace. So trends in crowdfunding, I think Woody's analysis was spot on in many ways, especially when you mentioned investor sentiment increasing. I think in the second half of this year, we've definitely seen that. We've also seen exciting growth as it relates to seeing more traditional venture-backed companies turning to Republic to fundraise, and that's definitely increased in the second half of this year. I think that's a testament to our increasing credibility of our platform, but also the shifts in the industry. In the US, similar to Dalmore, we facilitate fundraising through all exemptions, Reg D, Reg CF, Reg A, Reg S. And then we also leverage our European platform, Republic Europe, which was formerly Cedars, to offer parallel offerings. And so we put significant resources this year as well, just between streamlining the fundraising process on a global level. And really are helping founders navigate the complexities of fundraising. I loved how Stormer put it, of providing founders a toolkit, because that's been a big focus of ours as well. In 2024, we had a big focus on cultural assets, and more specifically tokenizing real world assets. And so by cultural assets, meaning access to assets like film, sports, real estate, music. There are several other new verticals on the horizon for us. And we found these opportunities that resonate really well and deeply with investors because they combine passion with diversification. And so, for example, sports has been a big focus for us. We launched Watford Football Club, a championship league out of London. That was a global opportunity, leveraging Reg D, Reg S, and then our European arm. And the idea is now fans can own a fractionalized equity in their favorite sports team. We also launched Republic Film in September, and the idea is, you can invest in film projects that you love and care about. And so, getting into real estate, these are now, assets that we're seeing fans and investors can interact with in a whole new way, and kind of layering tokenization on top of that, which is going to be a big focus for us in the coming year, which I can get into later. But to Woody's point earlier, also, we're seeing more debt opportunities. So especially as we get into providing more film within our film vertical, we're seeing a lot of revenue generating opportunities there, and assets like real estate, which just provide more consistent returns.
Okay, so I want to start with the US first, because I have questions both about domestic offerings and international offerings. Can you compare the Reg CF, Reg A markets and what type of deal volume you're seeing? Obviously, Reg CF, you can only raise up to 5 million. Reg A plus, you can raise up to 75 million. So they're different. But is that growing? Is it stagnant? What are you guys seeing right now today at Republic?
Yeah, on the Reg CF side, we're definitely seeing that growing, and more recently had some really exciting opportunities. I think one key difference as it relates to the European market, we've noticed, I think crowdfunding in the UK and Europe seems to carry less of a negative stigma in the industry, which has been interesting to see over the past 2 years. And I think largely that is due to a lot of the regulatory hurdles that we have for regulation crowdfunding. There's a lot of hoops that a founder has to jump through to launch an offering that then they can only raise up to $5 million for. And so, one of our focuses at Republic has been streamlining that process. And we actually took a lot of our learnings from Republic Europe, which has been around since 2009, a very long time. They've really built out a process that we then could take the technology, mirror it to make things more seamless for founders, which has been exciting to see, because I think that also, they come to Republic, a founder raises capital and they leave and they have a different perspective of the work that had to go into that to get the money or capital they were looking for, in addition to the community that they're building and the benefits that come with that.
Okay, so is Reg A or Reg CF more focused, or it's just equal?
Reg CF has been more of a focus, similar, I would say, to what Stormer was saying earlier around providing exemptions as a toolkit. It really depends on the opportunities and what they're looking to do. I think similarly across the board in the industry, Reg A's we've seen a slowdown just in approvals from the SEC. It's much more complex to get through. So we haven't seen as many of those as I think we'd like, and we're hoping that we'll see a lot more of those in the coming year.
Right. How important is Reg D for Republic US?
Very important, especially as it relates to, some of the recent deals that we've had. For example, within film, we might be launching concurrent Reg CF with a Reg D. And that's allowing, different, even for us with our infrastructure, when you do a Reg D offering, we allow for the payment of using crypto. And so that's a big benefit that you might not necessarily be able to do yet with Reg CF. And so, we look at it as a tool for founders to leverage that exemption to then figure out, if they're looking to raise more than 5 million, target accredited investors. But we definitely, it's very important. And we have a big focus on Reg D just as much as Reg CF.
Okay, awesome. I want to shift over to the UK Europe market, because Cedars, which you acquired, I think you announced it in 2020, correct me if I'm wrong, but that was there were effectively only two dominant platforms in the UK, and they were already active in the EU. But at one point, new rules were approved in the European, which are somewhat similar to Reg CF, because an issuer can raise up to 5 million euros in the EU. In the UK, it's a little bit different. But yeah, so what are you seeing in the UK specifically, and what are you seeing in the EU right now, today, 2024?
So our focus, as I mentioned, has been on cultural assets. So we're seeing a large pipeline increase as it relates to speaking with sports teams. Speaking to, I would say traditionally, especially Cedars was very focused on, your traditional venture deals. And so I think right now we're seeing expansion of just new industries having interest in leveraging crowdfunding as a way of raising capital and engaging their community in a way that they haven't done before. So that's been one thing we've seen. And then I think secondarily, there's been a focus in the UK around the secondary market. And so Cedars, as I mentioned, founded in 2009, I'm not sure of the date of when they started their secondary market, but it's been around quite a long time and really has shaped our understanding of how users are interacting with private securities. And we're now seeing deals like Revolut, which, I think started in fundraising maybe 2016. And, at the time their valuation was maybe 66 million. Now it's about 45 billion. And we're seeing investors actually, potentially be able to recognize and realize returns that are quite significant. And so it's now, so many years later, we're starting to see just investors experience this. And I think that has a big impact on the industry and how investors view crowdfunding and these opportunities going forward.
Yeah, venture capital is not for the impatient. So is it safe to say that Republic globally will enable over $1 billion in 2024 in total?
In total, since our inception, Republic has raised about over 2.6 billion in our ecosystem.
You're not going to share what you've done in 2024?
I don't know the full numbers. I don't want to misstate
Okay.
it. Yeah.
All right. Usually you guys produce a report at the end of the year, and I'm looking
And we
forward to
will.
seeing that.
Stay tuned for that in mid-December. You'll see our annual report come out.
Awesome. So I want to jump back to Woody again. Woody, can you share your expectations for 2025? And right now I'm hearing a lot of excitement about the coming year, a lot of enthusiasm for different reasons, but I'm going to pass the microphone once again to the expert, Woody. So tell us, what is going to happen in 2025?
All right, so here's my crystal ball. By the way, my crystal ball starts with this statement. Everything that's happened to date has been a prelude to the future that is going to just be the normal way that startups raise money. And what I'm trying to say is, startups have historically thought, I need to go to VCs if I want to raise capital to scale and grow. VCs for the past, 2 years have pulled back. They've been funding their own companies. They've been holding on to their cash. And I think when they come back into the space, they're going to be focused on, let's skip the risky things. Let's focus on the companies that are showing scaling, that survived the past few years, and are going to give us the exits that we need to have so we can give it to our LPs. So what does that mean is every single startup in the future is going to have to use regulation crowdfunding or one of these exemptions to do their capital formation, their initial seed rounds. You'll still do your friends and family, but you're going to be doing that online as opposed to this offline friends and family round that you're going to do. And that's going to be this fundamental shift that's going to bring many, many more deals, many more investors, and a lot more capital into the marketplace. And so when I talk about these projections for 2025, I'm talking about it from the point of view that the seeds have been planted. The industry's at this, beyond this tipping point. We saw the tipping point in 2021, then we had the pullback. Now I think we're back to the tipping point again, because I think with this new administration coming in, it's a couple things. We've calmed down, we've seen the public market go up. And so, people that have capital invested are ready to deploy more capital, I believe, into the private marketplace. I think that's one part of the equation. The other part is everyone's sort of excited about what the new administration means for the capital markets in general. I think for the private capital markets too, I think everyone's looking at, okay, now's the time, let's all get back in. So I think we're going to see a lot more attention in the space, which is why I believe capital commitments are going to exceed $750 million just in the Reg CF parallel side for 2025. I think new deal growth is not going to have that, it's about 12%. I would love to see it double or triple, but I think that's like 2 years down the road. We still need the media attention. I'm very frustrated over the fact that Bloomberg, we integrated our data into Bloomberg. I can't get the reporters to actually cover the industry. It makes no sense to me that you've got all of this amazing seeds of innovation and entrepreneurship happening in 2,000 cities across the country, and I can't get them to focus their attention on writing these stories about what's happening in rural Colorado. So I think we're going to have new deal growth year over year. It'll probably be about 1,640. I do believe the difference really is going to be on the investor sentiment. I think the conversation around the table with investors that are in the marketplace is going to lead to more of them writing checks. So we had 193,000 or so checks written in 2024. I think that's going to grow dramatically in 2025, and we're estimating that to be about 330,000. I think, when we're looking at what happens in the marketplace itself, and I look at the deals that are coming online, the sector that I'm really excited about, technology, software, it gets all the attention. AI, everybody's talking about it. But I'm telling you, these companies that are in the healthcare and biotechnology and life science space, it is fascinating what we diligence in the venture fund on a weekly basis. I want to say that, we go over the entire, we're industry agnostic, but we look at so many healthcare deals just because it's really fascinating how they're applying even AI into healthcare and all that. And so I think that's going to be one of the areas that we see a lot of focus and growth in 2025. Of course, from the debt perspective, Food services and restaurants, I think more of them are going to be coming there because it's just cheaper cost of capital than they're going to get from the banks. And I think, there's a lot of opportunity. I don't know if you want to talk about it right now, but, if we can increase the cap from 5 million to 20 million, I think that'll fundamentally shift the type of companies that are coming in there. Why these companies that are larger, that really are like, I have like 5,000 customers that could be great investors in our business. Why we preclude those companies from using Reg CF, I think is ridiculous. I get the fact that Reg A is an opportunity out there, but the cost of going through the process with the SEC and the time, the legal, the accounting, a lot of companies just don't want to do that. And I think there's a lot of structure in Reg CF that would allow companies to raise up to $20 million in a very transparent fashion. I've heard very little fraud take place in this industry. I've actually heard the opposite, which is it's about time we had some sunlight shed on this. And it's great that you have all this data because it helps us understand what's happening in this marketplace. So I could go on, but I'll stop.
You could go on, and it's always awesome, Woody. You have such great information on the industry. I want to jump back to Stormer right now and hear Dalmore's expectations for 2025 and what you guys are planning for next year. If you can share any new services, features, functionality, anything cool that could be coming in the next 12 months for your platform and for your issuers.
Yeah, absolutely. I mean, we have some really exciting things in the pipeline that I can't share just yet, but we'll be able to in the coming quarters for sure. And I think, thematically what that is going to be is providing the infrastructure for our issuers to start today and plan their capital raise over time and leverage all of these different exemptions at their leisure. And to Woody's point, right, if crowdfunding in the future will be the status quo for startup fundraising, I'm still very bullish on the opportunity around test the waters. And if you were at the Reg A conference, that was bullet number 2 of my outlook for the coming years is if crowdfunding is that vehicle, why wouldn't the starting point be at TTW to at least start warming up your community? Because I think we can all agree community is the epicenter of a capital raise with crowdfunding. And the compliant way to do that prior to launching your CF is through a Test the Waters initiative. So I think if you tie all that together, some updates and whatnot, I think TTW is going to be a very, very exciting opportunity for every and all company to take advantage of at their leisure. And that's something I'm really focused on. Now, looking at fundraising, again, we're focused on Regulation D and Regulation A as the kind of core of what our issuers are leveraging. And I continue to have conversations with those managed capital funds that look at Regulation A. And so I see the industry continuing to mature with the participation of established brands, established names, and established fund managers participating in our arena, whether that's equity or presumably debt. I think the macro environment is really going to dictate what the investor's looking for. We've gone through pretty tumultuous interest rate environment, and investors were hungry for really strong yielding products. And some of our issuers have been able to deliver that, which is why they've done so well. And I think that's going to continue as we see, the macro environment start to unfold, what the cost of capital will ultimately look like. And at the end of the day, any participant in a CFA or D is looking for some form of return of capital over time. And at some point, these issuers need to hopefully, deliver on that. And I think the fund structure is one that can be very instantaneous, provide, results and leverage historical data through Regulation D and previous fundraising to provide that same opportunity to the retail environment. I'll pause there. That's kind of my thinking of what the landscape's going to look like as well.
Okay, thank you. So Emily, similar question. What's Republic's perspective on 2025?
Yeah, so 2025, I think similar to Stormer, we have a few upcoming announcements and exciting projects that I can't share more on just yet, but they are coming soon. So stay tuned for early in the year. But apart from that, our major focus and I think expectation for 2025 is that tokenization will have more widespread adoption and growth for our platform. I mentioned Watford Football Club earlier. It's a London-based Championship League team, conducted a global raise with us. So our infrastructure now provides the ability to tokenize equity, which we see several benefits to leveraging blockchain, allowing for liquidity as it relates to secondary markets. We believe blockchain is going to allow for easier trading of peer-to-peer transactions, especially for any private asset. We also see blockchain and tokenization as a way to simplify dividend distribution and payments. This is especially important, we're seeing in the film industry. And then lastly, we're seeing just the use of tokenization as an ability to provide more utility and engagement to fans and community, and really tap into crowdfunding in a way that hasn't been done before. So that is going to be a big focus for us. We really think that tokenization will take more center stage. Securities tokens backed by real world assets, doing what we're doing in a traditional way, but layering on the blockchain technology to that. Secondly, I think there is going to be a big focus with tokenization to also our secondary markets at Republic on a global scale. So I mentioned the Republic Europe platform earlier. We're adopting a lot of what they've built and kind of reformatting and relaunching what we have on the US side and globally. So that's something that's exciting, upcoming. And then I think, we all said shift in regulation right now. We highlighted the challenges with Reg A's. So I think I'm optimistic, and we're optimistic here that in 2025, there'll be some meaningful changes that could ease the process for Reg A's, maybe even Reg CF as well, from 5 to 20 million. That'd be something really exciting to see. And then additionally, as blockchain technology gains more mainstream acceptance, I think that could also drive more widespread adoption and help us propel forward. So lots of focus going into the new year on those cultural assets like sports, film, music, real estate for us. And yeah, excited to see what the new year brings.
Yeah, I have to say, from what I'm hearing, there's a lot of enthusiasm for the industry in 2025. People tend to be very bullish. You mentioned Reg A, the slowness of qualification of the SEC has long been an issue, and I think there's expectations that will be something that's addressed with the change in leadership. Also, the fact that the Senate has flipped, you've seen a lot of good legislation, common sense legislation emerge from the House, only to go over to the Senate and die in the Senate Banking Committee. And that's going to change. And I think you're going to see new rules for not only online capital formation, maybe we'll get the bump up in funding cap to Reg CF to 20 million, but also digital assets. I think you're going to see some developments in that. And Emily, since you brought up tokenization, Europe is a jurisdiction where they approved MiCA, which is markets and crypto assets regulation. And they're working on more clarification for digital securities. What are you guys doing there right now, and what do you anticipate doing in UK, EU in 2025 in regards to digital securities?
Yeah, so I think it's interesting. We're actually expanding and taking a lot of our learnings that we've been doing in the US. We had our token launchpad. I think we launched that back in 2021 potentially. And so we're taking a lot of our learnings and actually taking them to Europe, taking them to our Republic Europe platform. And, as I mentioned earlier, we're doing global opportunities where we do expect to, provide those opportunities and tokenize equity and do more security token offerings. And so I think it's exciting to see kind of the regulations changing on both ends, both in Europe and the UK and in the US. And we're really trying to push what we're doing on a global scale. And so, we have learnings on both sides. There's a lot of regulatory challenges to navigate on both sides to make sure that we're always in compliance. And so I think that's been a challenge, but something we're excited to see in 2025 because a lot is changing in a positive direction.
Okay, that's good. So I want to address another regulatory issue that I believe is going to change the definition of an accredited investor. At this hearing I was watching today, that issue came up several times. It's garnered bipartisan support in the House. Again, it then legislation went over to the Senate and just, festered. It went nowhere. I'm going to start with you, Stormer, and I want to, how could that impact online capital formation and Dalmore Group if we get a sophistication qualification for Reg D offerings?
It's a really good question. I mean, we've looked at the public markets over the last 10 years and it's grown exponentially. That's going to inherently, grow the net worth of investors into that accredited status. Now, whatever happens with the true definition is to be found. But I think what will come of that is the decision that issuers will need to make in terms of which type of audience they're catering to and what their offering is going to be structured as. Today there's very clear definition, and Reg A or CF can cater to one audience, and Reg D is reserved for the higher net worth. And so I think if there's an expansion there, in terms of the definition of an accredited investor, it will allow for more unique participation in the offerings, and maybe a larger participation in the CF and A space. So I'm not really sure, right? Like we don't know exactly what the turn's going to be, but I think our focus largely on funds. That's an audience that's been hyper focused on the accredited space and just entering into the non-accredited. And so if that ability to expand that audience, it's only going to benefit the issuer, in my opinion. And so I'll leave it at that. I think there's more to come, and we'll see what the new year holds.
Woody, the definition of an accredited investor currently is a wealth metric. It's based off your bank account. You have to earn more than $200,000 a year, have a net worth of over $1 million, not counting your primary residence. If they incorporate a sophistication qualification, which I anticipate they'll do, how does this impact the securities crowdfunding sector, in your opinion?
I mean, I think it'll, again, I agree with Stormy. It remains to be seen, but I think we need to look at it from the perspective of how they're limited. So right now, investors in Reg CF are limited based on income or net worth. Okay, whatever the maximum of 10% of your income or net worth. I can't remember anymore. And so what this will do, hopefully, it'll move those people out of that bucket. So if they're sophisticated, if they've got better means, they maybe can invest more. I don't know if that actually will turn into the truth, but it actually opens the door for people that have education, training, experience working with startups to be able to say, I might not make $500,000 a year, so I can invest $50,000. But I really believe in this startup. I actually have savings that will allow me to do it, and they can deploy more capital than what they're restricted to under the current framework.
Okay. Emily, this would impact you guys differently too, because you're currently doing, transatlantic securities offerings. This could be a boon for Republic.
It would actually be an awesome thing to see for our platform. I think, similarly to Reg CF limits increasing from 5 to 20 million, this would allow issuers to raise more capital on a global scale. I think reach a larger audience. More investors would get involved. I think in the U.S., just more investors generally would get exposure to this asset class. And I think we also have, for example, we have our Launchpad, which has utility token offerings. Currently, a lot of our utility token offerings are under the exemptions of Reg D and Reg S. And so there's an example where we're now opening up opportunities that were currently not available to unaccredited U.S. investors that may be available to more people. So I think that's exciting to see as well.
Okay, awesome. And I want to have another question for you, because you mentioned secondaries, Emily, and in Cedars, Republic Europe, in my opinion, established one of the most effective secondary marketplaces in this sector. And of course, this is largely due to the foresight of the founders, Jeff Lynn, but also the regulatory environment in the United States. You've talked about leveraging that model to the United States. Can you share some insight into enabling that here domestically?
Yeah, so it really has been leveraging, taking our learnings, because we have years now of learnings of how investors have interacted with that model, pain points, user experience pain points, and are now building, similarly, the ability to trade both, on a bulletin board model, very similarly to what we've built on Republic Europe in the US. A lot more regulatory hurdles. And I think one of the things that we've now found is leveraging the Republic wallet and blockchain And so you'll see we're actually taking kind of what they have, but layering on blockchain to allow for doing this in a compliant way under, U.S. securities and like rules and regulations. So can't share too much yet because there's a lot that's going to be rolled out. But it is exciting to see how we're able to take those learnings, implement them here, and take new technologies to make sure that to allow us to still facilitate it in a way that's possible.
Okay, I'll take that as coming soon to the USA.
Coming soon.
Awesome, coming soon. Stormer, you guys do a lot of Reg A's. I know it's been an effective segment of the industry for you guys. Reg A is actually an exemption which allows for immediate trading in securities if the issuer so chooses. What do you call it? Quasi-public. What are your thoughts on secondaries and enabling greater liquidity in these private securities markets for everybody?
Absolutely. Secondary is a very common conversation to have, especially with the platforms. I mentioned those who are doing fractional offerings, right? They're catering to their entire community and at some point need to offer some form of liquidity to investors. I think it's very powerful, but I think it has to be done very strategically. And where I've seen performance or results from secondary is when you have an established community, you've proven results, you have slightly a pent-up demand for liquidity. That's where I see secondary being very, very beneficial to the issuer from a brand trust, and then to the investor as well. That equal side of the trust equation, allowing them to exit positions and hopefully deploy that dry powder elsewhere. Where I don't see it working out is for issuers who are hyper-focused on secondary before they've ever done a primary offering. And it's a common topic that's mentioned is, I need to make sure that secondary is ready day one, following the close of that Reg A. And the reality is there going to be an appetite from your investor who just placed their trade to then go sell that position? And is there going to be a buy on that other side of the equation as well? I think secondary is the ultimate next step for the maturity of the industry to hopefully connect these secondary transactions and primary offerings to larger, more institutional brokerage accounts, managed capital, RIAs, and family offices. Because if you have a great product, it's structured in some form of dividend or yield, that's going to be enticing to the audience in the brokerage space, the RAs and family offices. And I think that ATS is the ultimate connection to those players, and that's going to expand the liquidity within the secondary market. Woody's ready to go.
Storm,
Yeah.
I think you've hit the nail on the head, but I think one of the things that's holding back the secondary trading marketplace is these aren't covered securities per se. And we need to actually lift it up from state jurisdiction back to federal level. And I think that's something that, the incoming administration or, the SEC could look at, because I think when you have to, either follow the manual exemption, which covers, 42 states, but you still have to go through this sort of compliance, it sort of holds back the whole secondary opportunity. And I think if we can lift it up to the federal level, but still have the ongoing disclosures that investors need, I think it will really enable secondary trading to take place.
Right. Yeah.
Yeah,
I would echo that.
That's a good point. Good point, Woody. I have a question for Emily and Stormer. What are your thoughts about creating a pipeline to professional investors, institutional money into, say, smaller offerings listed on the platform, or alternatively, perhaps getting these private securities offerings on, say, Robinhood or an E-Trade. I'm going to start with you, Emily, and then jump over to Stormer very quickly, and then we're going to see if we can answer a couple questions.
I think that there's a lot of value to doing that and getting more exposure. And I think there's still a big portion of individuals that probably have no idea these opportunities exist, or that they could diversify their portfolio into things like sports clubs and venture, or even have access to it. So I think partnering with a Robinhood or a distribution platform like that could be very impactful. And I think, even in speaking with a lot of partners, a lot of, institutions like that, there's a lot of interest in kind of seeing what we're doing and figuring out how to bring it to their market, because investors are kind of want access to that anyways. And it's either they're going to go direct to us or work with, a platform that they're already involved in. And so definitely see the value of kind of looking at new distribution channels. And yeah,
Yeah, and that to me seems like a natural, just
Yeah.
makes sense in my opinion. Stormer, do you agree, disagree?
I mean, it's exactly what I was alluding to. It's the most common question that I hear from issuers is distribution and marketing. Where am I going to raise the capital? Where are the dollars and investors coming from? And if there's an avenue for managed institutional capital to participate, and again, that's where the toolbox of Reg D has largely been helpful. I think it's amazing, and that is, I think, the next larger, more mature phase of the industry. And last thing, on the follow-on question about the accredited investor definition, I'd be very curious to hear a marketing agency's perspective on the change, should the accreditation status change, because that I think would have impact, bigger audience, larger checks can come from paid marketing efforts, and I'd be curious to hear their perspective.
Okay, awesome. So we got a couple questions here, and I want to hit them very quickly because we're really running out of time. Emily, you've already mentioned equity crowdfunding, adapting to the rise of blockchain technology and tokenization, digital securities, digital assets, crypto in 2025. Can you expand on that just for a second? Because I'm really curious as to what Republic's doing. You've done a lot already. I anticipate, bigger digital securities offerings, also, non-security offerings. Is this like, the main focus for you guys in next year?
It's a big focus for sure. And so, and it's really because we've now built the infrastructure to facilitate this, and kind of mentioned it's going to enable a lot of what we're doing on our secondary platform to drive a lot of liquidity and ease of trading. So that's one thing we're really excited about. We've developed the Republic wallet. And so by tokenizing, doing security tokens that are backed by real world assets, backed by equity, backed by, a security, we really are excited to leverage the technology to figure out and kind of allow for an ease of user experience. So that's with the liquidity and trading, that's with your payment distributions. That's been a big pain point, whether you're a company that's IPOing or you're a film producer and you have these payments. I think my one colleague was mentioning she receives a check in the mail for 13 cents every quarter for something she did in the film industry. And so, being able to solve that distribution process and dividend payment process is exciting. And then lastly, the utility that you can bake into tokenization. So for example, for a football club like Watford, owners can have different levels of benefits that they unlock. So for example, with their tokens, say they have 100 tokens, maybe they're able to walk through an owner's entrance into the stadium. If they have 500 tokens, maybe they're able to unlock VIP parking. And so, it's interesting even sitting down with Watford to figure out what sort of perks and benefits should they be offering fans at different levels of ownership. And so there's a way to use tokenization to then really try to unlock new fan behaviors and new interactions within your community and kind of develop that engagement that you might not have otherwise.
Awesome. Yeah, digital securities, digital assets, they are the future. Stormer, I'm going to ask you this question. It's a little bit tangential, but I know you're going to do a good job of answering this. Somebody's asking, how much should I put into community building and social media in building a significant community to ensure success of an online offering?
A lot. I think it should be the focus of your fundraising efforts. You go the institutional route, plan on 100 VC conversations and 99 no's. Put that same effort in towards building a community around your offering and around your business. It's only going to benefit the eyes and the interest for that potential fundraise. Full circle to test the waters. That's an opportunity for the issuer to vet and start warming up their community. So I think if you're going to approach a crowdfunding raise, the question you should be asking yourself is, where is the capital going to come from? If your expectation is the platform itself is going to completely facilitate your $5 million offering, I think your expectations are a little far off, and that it should be driven by your community. Your community is the one who knows your business the best, feels most passionate about it. Every other individual is going to need a lot of touch points, a lot of selling, and a lot of desire to participate if there's not that early adoption from your own community.
Awesome. Yeah, thank you very much for that. Last question, Woody. Again, this is a little bit off topic, but that's okay. I'm a startup looking to launch their first securities offering. What's the most common mistake that you have seen? And I know you've seen it all, so you can do a good job of answering this.
You need to price your round appropriately. We invest in these deals, but we pass. Like if your revenues do not match a multiple for where your valuation's at, we just skip over the deal. The crowd is not stupid. They're actually very smart, and it's made up of people that are very sophisticated and can look at this stuff. So price your round appropriately. The other thing that I would say is, this industry that we're in is very much akin to what we see in our lives when we're in middle school and you're getting on the dance floor, and nobody wants to be the first one on the dance floor, and nobody wants to, be the, first to ask, but someone has to do it. And this industry is critical for people to see other people investing in your deal. So I think it's really, really important, that your platform's showing the amount that's being raised on there for other people to see, so that you know that you're not the first one in there. But B, you need to be out there and soft circling before your offering goes live, a good 30% of that deal. So when it does go live, people are like, whoa, okay, I'm going to follow. So those are two really critical things that I think will, help people that are interested in getting into, these offerings.
Okay, it's spot on as always. So we've run out of time. I'm going to ask each of you to kind of share, your words of wisdom for 2025. I'm going to start with Emily first. Final words.
Yeah, final words. Just excited to see what happens. And definitely stay tuned. We do have some announcements that we're going to be making, and I think, excited to think for us, another big focus, just education, getting more people involved in the industry, aware of the industry, aware of what we're doing, I think is going to be a big focus as well. I'm excited to see how 2025 helps propel that.
Awesome. Stormer, final words.
I think, the preparation for any crowdfunding offering happens many, many months before you go live on your campaign. And so using that time, that opportunity starting today, right? If you're thinking of maybe some offering in the new year, you can start that process today, building up an audience, creating awareness, creating community in a compliant way. And I would focus on that, right? And my suggestion is have a conversation with one of us on the panel here. We're happy to help and be a resource for issuers as they're getting started. But time is of the essence, and start today, and you never know when that community is going to be beneficial in the future.
Absolutely. Woody, 2025, words of wisdom.
All right. Mine come down to what we can do to improve the industry in itself. And so first and foremost, let's increase that cap to 20 million. Second, let's come up with tax credits and incentives that will engage more investors in the marketplace, de-risk the investment, and just really get them more engaged in this market. And then 3, we really need to update the regulations. We need to allow for small venture funds to be able to leverage this to raise capital, particularly if VCs are going to be moving upstream. We need to allow these funding portals to do investment advice in a limited way, so that they can actually help the crowd look at deals better. And I think there needs to be some revisions to the audit requirements in there. But I think if we do that, we're just really going to, I think we've got a lot of learning that we've already had to date. And I think we know simple things that can help get it to the next level. And I think 2025 is the year we need to put it all in place and really take off from here.
100%. Nailed it, Woody. All right. I want to thank everybody for joining us today. And I want to thank Emily, Stormer, and Woody for sharing your wisdom, your insight, your experience. Once again, you guys really, I learned a lot, and I know everybody who watches this, come back with some excellent information. And I want to wish everybody an excellent rest of the year, happy holidays, and all the best for 2025. Thank you so much for joining us, and take care.